In November 2022, over 1 million customers around the world tried to log into their FTX accounts and found they couldn't withdraw a single dollar. This wasn't a market crash. Bitcoin hadn't collapsed. The broader crypto market was still trading. What had happened was something far more deliberate and far more devastating. In less than 8 days, FTX, once valued at $32 billion, once celebrated as the safest and most sophisticated crypto exchange in the world, had completely imploded. Its founder, Sam Bankman-Fried, had graced the covers of Forbes and Fortune. He had donated hundreds of millions to political campaigns. He had testified before the United States Congress as the responsible face of crypto. And behind all of it, he had secretly been using his customers' money to fund his own trading firm's losing bids. Today, we are going to go beyond the headlines. We are going to look at exactly how this happened, the financial mechanics, the structural failures, and what it means for the future of fintech regulation. To understand why FTX collapsed, you first need to understand what it was and, more importantly, what it was hiding. FTX was a centralized cryptocurrency exchange founded in 2019 by Sam Bankman-Fried, or SBF as he was known. At its peak, it was handling over $10 billion in daily trading volume, making it the second largest crypto exchange in the world. FTX also issued its own token called FTT. Think of it as a loyalty point for the exchange. Holders got trading discounts, and FTX used FTT as collateral for various financial operations. Now, here is where it gets interesting. SBF also owned a separate company called Alameda Research, a quantitative trading firm and hedge fund. On paper, FTX and Alameda were completely independent entities. In reality, they shared the same leadership, the same office, and, as we would later discover, the same pool of the money. FTX held customer deposits. Customers believed reasonably as that their funds were being held safely, the way a bank holds your savings. What was actually happening was that those customer funds were being quietly transferred to Alameda Research, which uses them to make highly speculative bets in the crypto market. This is not a gray area. This is not a complex accounting question. This is, by any legal definition, fraud. But for 3 years, nobody knew. The unraveling began on November 2nd, 2022, when a crypto news outlet called CoinDesk obtained a leaked balance sheet of Alameda Research. What they found was alarming. Alameda's largest asset by far was not cash, not Bitcoin, not Ethereum. It was FTT, the same token issued by FTX, a token whose value was entirely dependent on FTX's continued success. In other words, Alameda financial health depended on FTT's price, and FTT's price depended on FTX's credibility. It was circular, it was fragile, and it was about to break. On November 6th, Changpeng Zhao, the CEO of Binance, FTX's largest competitor, publicly announced that Binance would be selling all of its FTT holdings, worth approximately $580 million. He cited recent revelations as his reason. The market reacted immediately. FTT's price began to fall. As FTT fell, Alameda's collateral value collapsed, and Alameda needed more funds to cover its positions. The only place those funds could come from was FTX customer deposits, but customers had already started to panic. Withdrawal requests flooded in, over $6 billion in a single day. FTX simply did not have the liquidity to meet them. On November 8th, SBF announced that Binance had agreed to acquire FTX. Market stabilized briefly, but the following day, Binance reviewed FTX's actual books and walked away. The statement from Binance was short and devastating. The issues were beyond our ability to help. On November 11th, FTX filed for bankruptcy. SBF resigned, and 1 million customers were left with accounts they couldn't access, holding assets that may never be fully recovered. 8 days, that is all of it took. Now let's look at the financial mechanics, because understanding the structure is what separates analysis from storytelling. The leaked Alameda balance sheet shows that total assets of approximately $14.6 billion, but of that, $5.8 billion was FTT, an illiquid self-issued token. Another $3.4 billion was in other crypto assets with limited market depths. On the liability side, Alameda owed approximately $8 billion, much of it to FTX-owned customers whose deposits had been quietly moved over. This is a classic case of liquidity mismatch. The liabilities customer withdrawals were short-term and immediate. The assets, illiquid crypto holdings, could not be sold quickly without crushing their own price. If this structure sounds familiar, it should. It's the same fundamental problem that caused the 2008 financial crisis. Banks holding long-term, illiquid mortgage assets against short-term deposit liabilities. When confidence fails, a bank run follows. The same logic applies whether you are dealing with mortgage-backed securities or self-issued crypto tokens. The key difference is this: in 2008, depositors in regulated banks were protected by government deposit insurance. FTX customers had no such protection. There was no regulator standing by to guarantee their funds. There was no central bank prepared to act as lender of last resort. FTX had deliberately registered its main exchange in the Bahamas, a jurisdiction with limited oversight, specifically to avoid the regulatory requirements that would have applied in the United States or Europe. This is known as regulatory arbitrage, and it worked until it didn't. Perhaps the most troubling question is not how FTX collapsed, but why nobody caught it sooner. FTX had audited financial statements to accounting firms. Amanino and Pragmatis had signed off on its accounts. But these audits focused on the entities they were given access to. The intercompany flows between FTX and Alameda were structured to avoid scrutiny. There is also a political dimension. SBF was one of the largest donors to the 2022 U.S. midterm elections, contributing to both Democratic and Republican campaigns. His public position as a responsible crypto advocate, someone who called for regulation, made regulators less likely to investigate. He appeared to be on their side. And finally, there is the broader failure of the crypto industry self-regulatory model. In the absence of mandatory reserve requirements, mandatory audits of customer funds, or mandatory separation between exchange and proprietary trading operations, all of which apply to traditional banks and base sale. There was simply nothing structurally preventing what SBF did. The controls that exist in traditional finance to prevent exactly this type of fraud, deposit segregation, capital adequacy ratios, independent custody, did not apply to FTX, and customers paid the price. So, what do we take away from FTX? For investors, the lesson is about verification, the concept of proof of reserves, where an exchange cryptographically proves it holds sufficient asset to cover all customer deposits, has gained significant traction since FTX. Before depositing funds on any centralized exchange, ask, can they prove they hold what they claim to hold? For regulators, FTX was a turning point. The U.S. Securities and Exchange Commission has dramatically accelerated enforcement actions against crypto platforms since 2022. In Europe, the Markets in Crypto Assets regulation known as MiCA came into force in 2024, introducing mandatory reserve requirements, customer fund declaration, and listing obligations for crypto exchange operating in the EU and for the fintech industry more broadly. FTX has accelerated a fundamental debate. Should crypto be held on centralized exchange at all? Decentralized exchanges, which allow users to trade directly from their own wallet without depositing funds with a third party, eliminate the custodial risk that FTX exposed. Their adoption has grown significantly since the collapse. But perhaps the most important lesson is the simplest one. FTX had sophisticated technology, it had celebrity endorsements, it had political connections, it had audit accounts, and none of mattered because the person in charge had decided that the rules did not apply to him. In finance, trust is infrastructure. When it breaks, everything built on top of it breaks too. FTX didn't fail because crypto failed. It failed because one man decided that his customers' money was also his money, and for 3 years nobody was watching. Thank you for watching. If you found this analysis useful, please consider subscribing, and if you are studying in fintech or financial regulation, I would encourage you to read the FTX bankruptcy examiner's report. It's one of the most detailed accounts of financial fraud ever made public.